how your insurance company is planning to screw you and how to fight back. Welcome back to Loxona, where millionaires are made, not born. I'm about to share something that could save you hundreds of thousands of dollars, and it's knowledge that insurance companies absolutely do not want you to have. Picture this. You've worked your entire life to build wealth. Maybe you own rental properties. Maybe you just bought your dream home. Or maybe you're renting and think you don't need to worry about insurance. Then disaster strikes. A hurricane rips through Florida, a tornado tears through Oklahoma, or a wildfire engulfs your neighborhood in California. You think you're covered because you've been paying premiums for years, right? Wrong. Let me tell you about real people who got completely destroyed by their insurance companies. Take Johnny Depp's former business manager who lost his Malibu home to wildfires. The insurance company initially offered him a fraction of what it would cost to rebuild, claiming his home was overinsured. It took years of legal battles to get a fair settlement. Or consider the thousands of Hurricane Katrina victims who were told their flood damage wasn't covered because it was storm surge, not flooding. These weren't poor people who couldn't afford lawyers. These were middle-class Americans who thought they were protected. Dave Ramsey always says you need to protect your wealth, and insurance is supposed to be that protection. But here's the brutal truth. Insurance companies are not your friends. They're businesses designed to collect premiums and pay out as little as possible when you file a claim. Today, I'm going to arm you with the knowledge to fight back, whether you're a homeowner or a renter. Before we dive in, let me ask you this. Have you ever actually read your entire insurance policy? And I mean every single page, every exclusion, every limitation? Drop a comment below and let me know, because I'm willing to bet most of you haven't. Don't worry, most people haven't, and that's exactly what insurance companies count on. Let's start with the biggest scam in the insurance industry: actual cash value versus replacement cost coverage. This is where most people get absolutely destroyed, and it's the difference between getting fairly compensated and getting pennies on the dollar. Actual cash value means your insurance company will pay you what your property is worth today, minus depreciation. So if your 10-year-old roof gets destroyed, they'll pay you for a 10-year-old roof, not a new one. If your 20-year-old hardwood floors get ruined, they'll pay you for 20-year-old floors. This is highway robbery, and it's completely legal. Take the case of Sarah Mitchell from Texas. Her home was destroyed in a tornado in 2019. She had been paying premiums for 15 years, but her policy only covered actual cash value. Her insurance company paid her $80,000 for a home that would cost $250,000 to rebuild. She's still living in a trailer on her property because she can't afford to rebuild. Replacement cost coverage, on the other hand, pays you what it actually costs to replace your property with new, similar items. This is what you want, but here's the catch. It costs more, and most people cheap out on their premiums. Dave Ramsey would tell you this is the dumbest place to save money, and he's absolutely right. But even replacement cost coverage has a dirty secret. Most policies have what's called a coverage limit. Let's say you have $200,000 in dwelling coverage, but it actually costs $300,000 to rebuild your home after a total loss. Guess what? You're eating that $100,000 difference. This is why you need guaranteed replacement cost coverage or extended replacement cost coverage. These policies will pay above your coverage limits if construction costs have increased. Yes, they're more expensive, but when your house burns down and construction costs have doubled due to supply chain issues, you'll thank me. Now, let's talk about renters, because 80% of renters don't have renter's insurance, and that's financial suicide. Your landlord's insurance covers the building, not your stuff. If there's a fire, flood, or break-in, you're on your own for everything you own. Michael Torres from Denver learned this the hard way. His apartment building caught fire, and he lost everything. Furniture, electronics, clothes, everything. He thought his landlord's insurance would cover it. Wrong. He had to start over from zero, sleeping on friends' couches and rebuilding his life from scratch. A $20 per month renter's policy would have covered all his belongings. But here's what most renters don't know. Renter's insurance also covers you if someone gets injured in your apartment. If your friend slips and falls in your kitchen and breaks their leg, they can sue you for medical bills and lost wages. Without renter's insurance, you're personally liable for everything. Renter's insurance also covers additional living expenses if your apartment becomes uninhabitable. If there's a fire and you can't live in your apartment for 6 months, your policy will pay for hotel bills and restaurant meals while you're displaced. Without it, you're paying those costs out of pocket while still paying rent on an apartment you can't live in. Now let's talk about the games insurance companies play when you file a claim. They have entire departments dedicated to finding ways to deny, delay, or underpay your claim. They'll send out adjusters who work for them, not for you. These adjusters are trained to find every possible reason to pay you less. Here's what you need to know. You have the right to hire your own public adjuster. These are licensed professionals who work for you, not the insurance company. They know the games insurers play, and they know how to fight back. Yes, they take a percentage of your settlement, but they often get you 3 to 4 times more than you would have gotten on your own. Consider the case of Robert and Linda Johnson from Louisiana. Hurricane Laura damaged their home, and their insurance company's adjuster said the damage was worth $25,000. They hired a public adjuster who found $120,000 worth of damage. Same house, same damage, nearly 5 times the payout. Which adjuster do you think was telling the truth? Speaking of truth, let's talk about the documentation you need to protect yourself. Insurance companies love to claim that damage was pre-existing or that you don't have proof of what you owned. This is why you need to document everything. Take photos and videos of your entire property, inside and out, at least once a year. Document all your possessions, especially expensive items. Keep receipts for major purchases. Store this documentation somewhere safe, preferably in the cloud, because if your house burns down, those photos on your kitchen table aren't going to help you. For renters, this is absolutely critical. Walk through your apartment with your phone and film everything. Open every closet, every drawer, every cabinet. If you don't have proof you owned it, the insurance company won't pay for it. But here's something most people don't know. You should also document the condition of your property throughout the year. If a storm damages your roof, but you don't have proof that the roof was in good condition before the storm, the insurance company will claim the damage was from normal wear and tear, not the storm. Now let's talk about the exclusions that will absolutely destroy you if you don't understand them. Every policy has exclusions, and insurance companies bury them in fine print. Flood damage is excluded from most homeowners' policies. Earthquake damage is excluded in most areas. Mold damage is often excluded or severely limited. But here's the sneaky part. Sometimes damage that looks like it should be covered actually isn't because of how it's defined in your policy. Let's say a tree falls on your house during a windstorm. You think that's covered, right? Not necessarily. If the tree was diseased or dead before the storm, the insurance company might claim it was a maintenance issue, not storm damage. This happened to Mark Stevens in Georgia. A massive oak tree fell on his house during a severe thunderstorm. The insurance company sent out an arborist who claimed the tree had been dying for years, making it a maintenance issue, not storm damage. Mark had to hire his own arborist and fight for 8 months to get his claim paid. This is why you need to read every single exclusion in your policy. If you live in a flood-prone area, you need separate flood insurance. If you live in earthquake country, you need earthquake coverage. If you live in an area prone to hurricanes, you need to understand what is and isn't covered under your windstorm coverage. Let me ask you this. Do you know what the deductible is on your policy? Not just the number, but how it's calculated. Comment below with your deductible amount, because I guarantee some of you are going to be shocked when you find out how much you'll actually have to pay out of pocket. Many policies in hurricane-prone areas have percentage deductibles, not flat dollar amounts. So if you have a 2% hurricane deductible and your home is insured for $500,000, your deductible is $10,000. That's 10 grand out of your pocket before insurance pays a dime. But here's where it gets really ugly. Some policies have separate deductibles for different types of damage. You might have a $500 deductible for theft, a $1,000 deductible for wind damage, and a $5,000 deductible for hail damage. The same storm could hit you with multiple deductibles if it causes different types of damage. Now let's talk about something that destroys more homeowners than anything else: being underinsured. This happens when you don't have enough coverage to actually rebuild your home. Maybe you bought the cheapest policy available, or maybe construction costs have increased since you bought your policy. Here's the scary part. If you're underinsured, even by a small amount, you could trigger what's called a coinsurance penalty. This means the insurance company will reduce your payout on every claim, not just total losses. So, if you're 10% underinsured, they might only pay 90% of every claim you file. This destroyed Patricia Williams from California. Her home was worth $400,000, but she only had $300,000 in coverage to save money on premiums. When a wildfire damaged her kitchen, the insurance company applied the coinsurance penalty and only paid 75% of her claim. She ended up paying thousands out of pocket for what should have been a covered claim. This is why you need to review your coverage amounts every year. Construction costs fluctuate, and your policy needs to keep up. Don't just accept the automatic renewal. Actually look at your coverage amounts and make sure they're adequate. Let me tell you about the biggest mistake I see people make: choosing their insurance company based on price alone. Dave Ramsey always says, "You get what you pay for," and nowhere is this more true than insurance. The cheapest policy is often the cheapest for a reason. It has more exclusions, lower limits, and worse claim service. When disaster strikes, you want an insurance company that pays claims quickly and fairly. You want a company with a good reputation for customer service. You want a company that's financially stable and isn't going to go bankrupt when they have to pay out millions in claims after a major disaster. Check the financial strength ratings of insurance companies before you buy. AM Best, Moody's, and Standard & Poor's all rate insurance companies. Don't buy coverage from any company rated below A-. Yes, they might be cheaper, but when you file a claim, you might find out why. But here's something that might surprise you. Sometimes the big well-known insurance companies are the worst when it comes to paying claims. They have more resources to fight you, more lawyers to find reasons to deny your claim, and more bureaucracy to slow down the process. This is why you need to research the claims-paying reputation of any company you're considering. Your state insurance department keeps records of complaint ratios for different companies. Check these before you buy, because a company that fights every claim is not a company you want to do business with. Now let's talk about liability coverage, because this is where you can really get destroyed financially. Your homeowner's policy includes liability coverage that protects you if someone gets injured on your property or if you accidentally damage someone else's property. For renters, this protects you if someone gets injured in your apartment. Most policies come with $100,000 in liability coverage, but Dave Ramsey recommends at least $500,000, and I agree. Why? Because if someone gets seriously injured on your property, $100,000 won't even cover their medical bills, let alone pain and suffering damages. Ask Tony Martinez from Arizona. His neighbor's kid broke his arm falling off Tony's fence. The medical bills alone were $60,000, and the family sued for another $200,000 in pain and suffering. Tony only had $100,000 in coverage, so he had to pay the rest out of his own pocket. But here's the real kicker. You should seriously consider an umbrella policy. These provide additional liability coverage above your homeowners and auto policies. $1 million in umbrella coverage might only cost you a few $100s per year, but it could save you from financial ruin if you get sued. Think about it. If you're building wealth, you have more to lose. You're a bigger target for lawsuits. An umbrella policy protects everything you've worked for, and it's some of the cheapest protection you can buy. Let me ask you this. Have you ever had to file a homeowner's or renter's insurance claim? If so, what was your experience like? Drop a comment and let me know, because I'd love to hear your stories. Here's another dirty trick insurance companies use. They'll try to settle your claim as quickly as possible, often before you even know the full extent of your damages. They'll show up with a check and pressure you to sign a release that prevents you from filing additional claims for the same incident. Don't sign anything until you're absolutely sure you understand the full extent of your damages. Get multiple estimates for repairs. If you're not sure about the settlement offer, hire a public adjuster or an attorney who specializes in insurance claims. It might cost you some money up front, but it could save you tens of thousands in the long run. Now, here's something most people don't think about: keeping good records throughout the claims process. Insurance companies are required to handle claims in good faith, but they don't always do it. If you have to sue them later, you'll need documentation of every phone call, every email, every interaction you had with them. Keep a claim diary. Write down the date, time, and content of every conversation you have with your insurance company. Get the names and employee numbers of everyone you talk to. If they promise to do something, get it in writing. This documentation could be crucial if you end up in a dispute. Speaking of disputes, let's talk about what to do if your insurance company denies your claim or offers you a lowball settlement. You have options, but you need to act quickly because most policies have time limits for filing appeals or lawsuits. First, read your policy carefully to understand why they're denying your claim. Sometimes it's a legitimate exclusion, but often it's just the insurance company trying to save money. If you think they're wrong, don't just accept their decision. You can file a complaint with your state insurance department. These departments regulate insurance companies and can sometimes pressure them to reconsider their decision. It's free and it's often effective. If that doesn't work, you can hire an attorney who specializes in insurance law. Many of these attorneys work on a contingency basis, meaning they don't get paid unless you win. They know the games insurance companies play, and they know how to fight back. But here's the most important thing Dave Ramsey would tell you. The best way to deal with insurance companies is to never have to deal with them at all. That means taking steps to prevent losses in the first place. Maintain your property. Fix problems before they become disasters. Install smoke detectors, security systems, and storm shutters. Take pictures of your property regularly so you can prove its condition before any damage occurs. For renters, this means being proactive about safety too. Don't overload electrical outlets. Keep fire extinguishers handy and report maintenance issues to your landlord immediately. Document everything in writing. Now let me tell you about something that's going to change your entire approach to personal finance. I'm launching an exclusive Patreon community where I'm going to share wealth-building strategies that nobody else is talking about. We're going deep into mindset and money management, personal finance techniques that the wealthy use but never share publicly. This isn't going to be the same recycled advice you hear everywhere else. I'm developing comprehensive courses on building real wealth, protecting that wealth, and creating multiple income streams. The kind of financial education that should be taught in schools but never is. If you're serious about building wealth and protecting it from predators like insurance companies, you need to be part of this community. The link is in the description, and I'm only accepting a limited number of founding members who are going to get access to everything I create going forward. Here's what most people don't understand. Insurance is just one piece of the wealth protection puzzle. You need to understand how to structure your assets, how to minimize your tax burden, and how to create multiple streams of income that can't be touched by any single disaster. That's exactly what we're going to cover in my Patreon community. We're talking about advanced strategies that most financial advisors don't even know about. Asset protection trusts, offshore accounts, real estate investment strategies, and business structures that protect your wealth from lawsuits, taxes, and yes, even insurance companies. But back to insurance, here's the bottom line. You need coverage, but you need to be smart about it. Don't buy the cheapest policy available. Don't assume you're covered just because you pay premiums. Read your policy, understand your exclusions, and document everything you own. Whether you're a homeowner or a renter, whether you're dealing with hurricanes, tornadoes, earthquakes, or wildfires, the principles are the same. Insurance companies are going to try to pay you as little as possible, and you need to be prepared to fight back. Remember what Dave Ramsey always says, hope is not a strategy. You can't hope your insurance company will treat you fairly. You need to know your rights, understand your policy, and be prepared to fight for what you deserve. What questions do you have about protecting yourself from insurance companies? Drop them in the comments below, and I'll answer them in future videos. And if you're ready to take your wealth building to the next level, check out my Patreon community. This is where we're going to build real wealth together and protect it from everyone who wants to take it away from you. Thanks for watching Homeowner, where millionaires are made, not born. I'll see you in the next video.